before Tuesday's open, and I'm going to introduce you to the Gilligan sell signal, because many Gilligans in the indices may have been a shot across the bow of the USS Bull on Monday. Let's take a look at the S&P daily index of the S&P, a daily chart of the S&P first. All last week, the bulls tried to get the S&P above the key 2800 level right here. You can see all these attempts here to try to get it above 2800. This is the same level where it failed 3 times, which I'm going to show you in a minute, last fall, but apparently there were too many sellers above this well-recognized, well-defined region, so the bulls did it overnight on Sunday with no one around, setting up an up-opening squeeze on Monday in tandem with President Trump delaying tariffs on China. So for the first time in a while, we had a change in complexion with the sell on the news, as many of the popular indices left signal reversal bars, including the S&P seen here. In other words, it ran up and tailed off, closing at near session lows. In so doing, the S&P left a Gilligan sell signal. This is a strategy I created in my best-selling classic Hit and Run trading books to identify exhaustion. It is a gap up to a new 60-day high with a close at near session lows. Now, the S&P wasn't alone in leaving a Gilligan. IWM, the ETF for the Russell 2000, also did so. Let's take a look. So you can see the same picture. Gap opening above the 200-day by coincidence, and a close at near session lows. This is a gap up to a new 60-day high with a close at near session lows, satisfying the criteria for a Gilligan sell signal. Let's take a look at the NDX, the NASDAQ 100. Same thing here. Big gap above the 200, unequivocally and with authority above the 200-day with a close at near session lows. So we have across the board signal reversal bars on the table in these 3 indices. A gap down tomorrow, which looks in play given the action in the Fute so far tonight. Last time I looked, they were down 10 points. We could leave an island top if these indices gap down and stay below tomorrow's perceived or expected open gap. Let's turn back to the S&P real quick and show why this level looks so important. This region is so important. And I'm going to pull the lens back so we can get a bigger picture of where we've come from and where we are now. Okay, so here is here's the January blowout top, which we'll show. First and foremost, this region just above 2800 here has been dominating the S&P for a year. There's something about 2800. Interestingly enough, given Gann, W.D. Gann's principle of squares, 53 squared is 2809, and you can see here in early October, the S&P probed 2813 on a push above its 200-day moving average. That's the magenta line here, and plunged. Same deal in early November, a push up just above 2800, in this case 2815 on a false move above the 200-day, and another plunge. Again, early December, makes a high on December 4th, 2800 even, back below the 200-day. That starts the Christmas massacre, the December massacre. So basically we tagged the same level, 2813, on Monday's high, and tailed off. A horizontal line shows what I call this line of most resistance versus Jesse Livermore's line of least resistance. This is a line that plays out from February at 2812, where the crash in February 2018 started from. And you can see that this line, what I'm calling the line of most resistance, was tagged on Monday morning. We can't rule out the possibility that the S&P is working on a right shoulder of a Head and Shoulders top. This would be the left shoulder, the January 2018 high. This area here would be the head, and this could be a right shoulder. Second, notice the confluence of three trend lines. Let's drill down a little so we can get a better look at them. Here you go. There's a confluence of three trend lines here in February, mid-February. The longest trend line extends from the, well, let's pull this back so you can see where this came from. The longest of these trend lines extends from the February-March double bottoms right up to mid-February here at about this 2750 level. And the second of the trend lines is a declining trend line connecting the November and December highs that came in right at the same level. Okay, and next I connected the November lows and the December low, and all these intersect right around this 2750, 2760 level, which tie to the 200-day moving average. The S&P broke out above all three of these trend lines in mid-February, obviously. Consequently, an important sell signal would be issued if the index knifes back below this intersection and holds. That intersection again ties to the 200-day moving average around 2750. Trade below that region that sticks will look like we've had a false breakout above the 200-day, just as occurred in October, November, and December. Now, fast moves come from false moves, and I see no reason to doubt the power of yet another failure below the 200-day if it happens. I'm watching a couple of technical signals that will telegraph the significance of Monday's signal reversal bar. First of all, the market has been in a runaway move. Let's pull back the lens again. Here's your December low. The market has been in a runaway move since the December low. I define that by the fact that there have been no more than two consecutive lower daily lows since the Christmas low. Here you've got two consecutive lower daily lows. Here you've got two daily lower lows, two consecutive daily lower lows, one, two, one, and one here. So remarkably, throughout this whole rally, this whole advance from Christmas, there have been no more than two consecutive lower daily lows. Now, interestingly, you have a little signal reversal bar, a Gilligan here, but a very small Gilligan. I think it's around February 12th, actually. But as I often say, longtime readers and subscribers will recall that I often say that the first mouse gets the cheese and the second mouse gets the first mouse gets the squeeze, the second mouse gets the cheese. By that I mean the first signal often sees those who jump on the short side, get squeezed, while the second signal, the second sell signal, gets the cheese for the bears. In this case, the same is true on the opposite, going the other way. First buy signal, second buy signal. So this may be a case where the second mouse, the second sell signal, gets the cheese. So As I've just showed, the S&P hasn't carved out more than 2 consecutive lower daily lows throughout the whole advance. If the S&P should carve out 3 consecutive lower daily lows, turning the important 3-day chart down in the process, and does not get upside traction from that point, it'll be a yellow flag, even if that should occur, or especially if that should occur above the 200-day moving average. So that'll be a yellow flag, that'll be a warning sign. At the same time, let's go to the 10-minute here. From today's high, it looks like you've got 1, 2, or 1, 2, 3, 4, 5 waves down, possibly can be counted. That's impulsive. This may be a third wave, subject to interpretation. But if the S&P should carve out a clear 5-wave pattern from the highs, it'll also warn of an impulse to the downside. The S&P could fully satisfy this pattern and be clear if the next little rally attempt to a lower high sees a rollover. Both of these will indicate, both of these technicals, the 3-day chart turning down and not getting traction, and 5 little waves to the downside, which would be impulsive, will indicate a test of the 200-day, which we previously defined as being the Maginot Line. Now, this could be a sell signal within the context, even in a bullish context, of at least a 5 to 10% correction. That said, as offered in Monday morning's hit and run report, let's go back to the dailies. Let's take a look at the weeklies, actually. As I offered in Monday morning's report, it is very possible that a B wave corrective rally is ending right here. Here you see a good picture of a possible head and shoulders. Left shoulder, head, right shoulder here. So in our report this morning, or Monday morning, we warned that we could be completing the B wave, a corrective B wave, to what was the fourth quarter A wave down. If that's the case, the presumption is a sinister C wave would follow, which would actually slice through the December 24th low, which was 2346. So that's at least 450 points lower, even if it just tests that low. But the implication is, if this is a B wave and we're going to get a C wave, that we're going to go below the December low. So the bottom line is that caution is warranted on a break of the 200-day. This is the 50-week, which ties to the 200-day. You can see this is around 2740.50 as well. So that's where a red flag will go up. We already explained where a yellow flag would go up, and a red flag would go up on another break below the 200-day moving average. So that's where caution is warranted. The bull case, if you broke below the 200-day, if you broke 2750-ish, and you got your 5 or 10% correction, and you held up in the low 2600s, that could be an inverse, big picture inverse head and shoulders pattern, which would negate the idea, if you then turned up, that would negate the idea of an A, B, C disposition. So this is a possible left shoulder. This is a possible inverse left shoulder. This is a possible inverse head, and a decline back down to this level. If it's symmetrical, would be around 2630, 2640, and could be an inverse right shoulder. So those are the two scenarios. Those are the two counts that I'm working on right now. And the bottom line is that in any event, we should get a significant, a meaningful correction, which could, even in the bullish context, go all the way back down to 2630, 2640. That's it for now. If you found this video helpful, please like and be sure to click on the link to get a free copy of my classic bestseller, Hit and Run Trading, and a trial to my morning report and the nightly stock report. Good luck out there. See you next time.